Well, can I introduce Paul Fisher to you? We are going to have a little chat about various issues in economics. The first one we're going to look at is inflation, and Paul is ideally placed to talk about this. Paul has worked for the Bank of England for many years. He was Executive Director of Markets. He was on the Monetary Policy Committee for 5 years. He was Private Secretary to Eddie George. When he was on the Monetary Policy Committee, it was with Mervyn King and then later with Mark Carney. So he has all the experience of how things should work in practice. He's also an excellent economist, a PhD in economics, visiting professor at many institutions, and certainly knows his stuff theoretically as well as seeing things in practice. In contrast, I've taught economics for so many years I don't really want to remember, and I've always been in the academic side of the subject, and for that reason I claim to have no experience of how things work in reality. So when you listen to us, you're going to listen to someone who has the ideas of a theoretical economist and someone who understands the ideas of a theoretical economist, but also has some practical thoughts on the subject as well. There are 3 questions that we're going to look at. Paul's popped them down. So do you want to pose the first question, Paul?
Well, thanks very much, John. Hello, everybody. We're going to discuss some issues which I think we'll agree on some things and we'll disagree on others, I hope. But one thing I think we can both agree on, maybe for different reasons. Why do we believe inflation should be kept low and stable, and therefore the principal responsibility of the central bank?
Well, firstly, I would love to have inflation so stable it was zero forever. I don't like inflation under any circumstances at all, but if you have to think of moving either side of an average, then you're looking at either inflation, a rise in the average level of prices, or deflation, a fall in the average level of prices. I am concerned that deflation does change people's perception of what's going on with prices, and there's something that builds on deflation that aggravates it and makes it even worse. That is, once people think that prices start to fall, then they hold back purchases, and when they hold back purchases, that actually reduces monetary demand further and is likely to aggravate the deflation more. And I think if you look historically at the sort of big deflations in the UK after the First World War, in America and the rest of the world during the Great Depression, then you'll see that they can be long drawn out problems once they start. So I want to avoid deflation. The only way really to avoid deflation is to have inflation as low as you possibly can, but stable. I don't like prices on average to be volatile. It's no good having 2% inflation one year, 10% the next year, 15% the next year, or whatever, because what markets need, what capitalism needs, what the economy needs is stability in prices. I have no concern, no worries about changing relative prices because that's happening all the time, but I would like the average price level to be stable in order to promote capitalism, to promote free markets, to encourage predictions, to be more precise about the future, investment analysis, more precise, less shocks in the economy. And so what rate would I choose? Well, I would go with the Bank of England's target of 2%. I think that 1% is possibly too low, because you then start to get close to zero and problems of deflation. I think in Japan we had the problem shown just by them trying to target 1%. It was quite a difficult thing to do, and I think generally the wisdom around the world now is that 2% is a good target, and therefore I would like to see 2% maintained over the long term.
Well, thanks very much, John. I don't actually disagree with most of that, but I would come at it from a slightly different perspective. For me, the big problem with inflation is that it acts like a tax, particularly on those with fixed incomes, who find out that over the course of the year their income is worth less than it was at the start of the year, and they don't really have anything much they can do about that. And in fact, in many countries, inflation is generated because governments want to spend too much money. They print that money because they can't borrow it or raise it in taxes. So it both acts like a tax and is intended to be a tax because of government irresponsibility, for want of a better word. So that's one reason, and it's always the poorest in society who suffer from any sort of economic mismanagement for some reason. Secondly, I work on quite a lot on the sustainability of the economy, trying to make the economy adapt to things like climate change and social pressures. And if you're always firefighting the next economic crisis, if you have high and volatile prices, it's very difficult to focus on the long term. It focuses people's focus much more on the short term about dealing with those volatile and high inflation rates. And so getting inflation low and stable is crucial for taking a long-term view of the planning of the economy, which is not that so different from what John was saying about making capitalism work better. What is low and stable? Well, 2% has a number of things going for it. One is it's about the rate of measured price inflation, which the volatility of inflation is at its lowest. There's good reasons to think that we mismeasure prices. Some people might think inflation's a bit higher than given by the CPI, but conventionally most people think inflation rates overstate the inflation. So actually 2% CPI inflation is closer to zero in terms of reality, and that's because specifically price indices are not very good at coping with quality changes. And if you think most of the goods we're buying improve in quality, but we're still measuring the prices of the same objects, that's where you can get an overestimate. And finally, I would say that, of course, we talk about aggregate price inflation, but prices move across the board for many different goods and services. And in particular, manufacturing price inflation tends to be lower than services price inflation, and 2% average gives you something close to zero for manufacturing, which tends to make up most of traded goods and helps keep things like exchange rates between countries stable. And also, some people will say that 2% inflation gives you some room to cut nominal interest rates below the inflation rate to get negative real interest rates and stimulate the economy that way.
Yeah, Paul makes a very good point, and I certainly agree with that we can look at inflation really as that unconstitutional tax. It is that tax on money, it's tax on cash contracts, which does raise income for government, and does it in a way that we haven't voted for. No one has said these people should pay this tax or these people should pay this tax, but there are redistributional sides to inflation that often mean that it's the poorer and the weaker groups in society, those with less knowledge about how to protect themselves. These are the people who are most affected by this unconstitutional tax, and therefore I think we would both like to see no inflation at all, but we do recognise that there are targets set, and those targets set should be as low as possible to do least damage and hopefully stable over the long term to make people act in a more predictable way than they would act faced with expectations of very volatile inflation.
Right, well, let's move on to our second question, which is, I think, one where I certainly hear in the common media the most misrepresentations of what I would believe. What is it that actually causes inflation? What's responsible for generating inflation?
Yeah, and this is where Paul and I will disagree a lot, because I am going to, I'm afraid, blame the Bank of England for inflation, whereas Paul has got to defend that case, I'm sure. If you look at the textbooks, and I have to teach it because the textbooks explain how there are two main causes of inflation. They are either cost push or they are demand pull. That was the normal Keynesian argument, whereas I've written several articles over many years explaining that cost push inflation is a myth. There is no such thing. You cannot raise the average level of prices by costs rising. By definition, inflation must be more units of money used in the same number of transactions. It cannot be anything else other than that. And if it's more units of money used in the same number of transactions, then you can't blame oil companies. They don't create more units of money. You can't blame higher wages. They don't create more units. You can't blame any costs for raising the number of units of money in the economy. So my concern is that inflation is always of a monetary demand pull type. So, I conceive the fact that I am a monetarist economist, and that is the usual argument for monetarists, going back to Hayek and Friedman, that there is only one cause of inflation, which is a monetary cause of inflation, and that we must look to the Bank of England or central banks to take responsibility for causing these inflations and hopefully controlling these inflations over the long term.
Well, of course, that's complete nonsense. I think there's a couple of points here. It is certainly true that in countries with very high inflation rates, and I should note that over half the world's population live in countries with more than 5% inflation, which I would call high. And it's double digits, triple digits in some countries. High inflation is still alive and kicking around the world. In those countries, it is always associated with high money growth, and one of the ingredients of getting inflation back under control would be restricting the growth of money. But certainly over the range of inflation which we would contemplate in Western markets, at 0 to 5% say, there is such a weak link between monetary growth and inflation as to make it almost negligible. And what we've seen over the last 10 years or so is a massive expansion in the monetary base and very low inflation, for example. I would favour an explanation. Actually, I don't really believe in supply shocks or demand shocks in terms of that cost push or demand pull inflation either. What happens is there are these shocks to the economy. That makes inflation move around for various reasons. You can have exchange rate shocks, you can have oil price shocks, you can occasionally have changes in labour market conditions causing shocks. As long as people believe inflation is going to be low and stable, it will remain low and stable. Most wage and price setters in the UK for some years now, many decades in fact, have believed that inflation is going to be around 2, and that is what guides inflation in terms of the outcome. But once you allow inflation to get away from 2 and people start to believe it's going to be permanently away from 2, they will adjust their behaviour, and any slack in the system in terms of money growth can then be exploited. And part of the problem we have is that money is not only used for transactions. In fact, it's not even principally used for transactions. Most people use money as a store of value. But if you build up a store of value, you can then draw it down for transactions if you want to, or you can build it up. And that's what gives you the looseness between money growth and the inflation rate. Just one small point for that, what we saw at the start of the pandemic in 2020 was the number of transactions went down in nearly every country, so you had supply and demand shocks, but the amount of money that people wanted to hold went up, and that was really for the precautionary motive. People wanted more cash in their pockets, even though they knew they weren't going to spend it. And so I think there is a difference between what causes inflation, what causes big inflations, hyperinflations, and what moves inflation around at more reasonable levels. And I say in many countries where they do get inflation rising to say 10-12%, often that is caused by loose fiscal policy, governments wanting to spend money, can't raise it in taxes or from borrowing, and then they will seek to just draw down money from the central bank. And that's not really the central bank causing inflation. They are subject to the whims of the government. The fiscal policy dominates, and that will end up causing inflation.
Paul obviously makes a number of good points from the perspective upon which he sees things. But I still don't agree. I see inflation always as money growth precedes the inflation. Now, money growth, when I talk about money growth, what I'm talking about really is an increase in monetary demand. And there are two components of monetary demand. One is the stock of money in the economy, so the physical quantity of money in the economy, and the other is the speed it's passed round, if you like, what's described as the velocity of circulation of money. And what happened during the pandemic is a really good example of this, because a lot of the money stock expanded. The Bank of England's balance sheet expanded considerably with the increases in government spending to try and deal with the pandemic. that increase in the stock of money is a very small component of the total amount of money in the economy. And for the total amount of money in the economy, you would need banks to act on the increased base that they've got in lending more money, but it wasn't a time when more money was being borrowed. You also had the situation where people were locked down, there was suppression of movement, so there was less money being passed around in the economy. There was a slowing of the velocity of circulation of money. So you had monetary stock increasing, but velocity slowing. Now that quite simply produces an indeterminate effect on the average level of prices. Prices could go up or down depending on the relationship between the stock and the flow. However, what you can say is that when things get back to normal, if they ever get back to normal, is that the velocity of circulation of money will tend to pick up and speed up again. So you've got your increase in monetary stock, you've got the economy starting to grow again, you've got banks starting to lend money, so at some point this inflation will come. I don't know exactly when the inflation will come, but that inflation will come. In fact, I might argue it's just about coming now. It's just about picking up. So we're now in September of 2021. We started increasing the money stock back in March, April of last year. The impact then 12 to 18 months later means that now we'd have inflation picking up. And indeed, this is interesting because Paul and I have sort of discussed rates of inflation over the last 6 months. Many economists were discussing deflation 12 months ago, whereas I've always been quite clear that this inflation is coming. I'm gradually pulling Paul up. Paul has sort of had a feeling that by the end of this year, inflation might be around the 2 or 3% mark, whereas I posed quite a long time ago that it might be up as high as 7%. And indeed, I've got sort of something in my back pocket just in case I'm wrong on CPI, because RPI might be closer to 7% than CPI this time, in as much as RPI, the retail price index measure of inflation, is usually 1 to 2% higher. Currently, it is at 4.8%, the RPI measure, the CPI measure only at 3.2%. But I don't see this falling back. I think now things are getting back to normal. This is going to pick up, and as it picks up, we'll get closer to my number, because I don't have much truck with inflationary expectations. I don't have much, unless they change the velocity of circulation, of course. My concern is always the rate at which you grow monetary demand, and if that rate accelerates as it has been, eventually that will filter through in higher prices, and we still have those to come. And I see very much a repeat now of what we had in the 70s in the UK, which you would then just describe as stagflation. So you can look forward to that towards the end of the year. If I'm right, if Paul's right, then hopefully it'll be fast economic growth and low inflation by the end of the year.
I have to admit, I am quite right, not because of monetary growth particularly, but actually all of the most difficult shocks to inflation and the economy generally that I've experienced over the last 30 years have not come from demand shocks and fast demand growth or weak demand growth. They're relatively easy to deal with. It's always been supply side shocks that have been the difficult thing for monetary policy to cope with. The risk at the moment is there's a lot of factors at work which are affecting relative prices in particular, and that's a combination of things like the Brexit causing labour market shortages, it's COVID causing supply side shortages, it's for some unusual conditions across Europe causing gas price shortages. Those things will just cause relative price changes. But people in these circumstances may come to believe that this represents a general increase in the rate of inflation. And if they do, that will be self-fulfilling. I do believe that inflation is something of a what we call a bootstrap equilibrium. It pulls itself up because of changes in behaviour. And of course, it would reflect itself in a calculation of a change in the velocity of money, because the velocity of money isn't stable. I'm one of those economists who spent a long time trying to model the money aggregates, and every time I thought I'd succeeded, of course, the rosy broke down. We even got to the point of fitting a model for a narrow demand for money, which worked over a 150-year period, and as soon as we published it, the relationship broke down. And that's basically telling you can't model and predict the velocity of money. It just moves all the time. But I think I would agree with John that we have loose monetary conditions, and those loose monetary conditions could allow inflation to pick up, and we need to be signalling quite soon that we are prepared to tighten policy if inflation looks like it's going to stay high.
Yeah, I don't disagree. I mean, Paul's describing to you the practical side of things. These things are very difficult to predict, very difficult to be precise about, but theoretically, I can see the links, and the links go. Something happens which causes the money supply to expand. That has an impact upon monetary demand. If output does not grow at a rate to absorb all that increase in monetary demand, then you're going to get a rise in the average level of prices. Relative prices are changing all the time, but the average only changes when you have got these more units of money. We were going to look quickly at another question, which was...
well, what are we going to do? How are we going to control inflation? If we both think worried about inflation going up, you more than me, what should we do to control it?
Well, you see, it's very easy from my point of view on how to control inflation, but much more difficult from your point of view because you have so many different causes that you have to control. From my point of view, you have to accept the current inflation. Whatever rate of inflation you've got at the moment, the current rate of inflation has been caused already. That happened last year, that was caused. So how do you bring that down? Well, the only way to bring that down is to bring the growth in monetary demand closer to the rate of growth of output. So we don't need monetary demand to expand more probably next year than 5%, allowing, wouldn't it be lovely, 3% growth in output, and you've achieved your 2% inflation. I mean, it sounds simple when you say it like that, and as Paul has said, the practice of this is not quite as simple. We all think this is going to happen, and then it doesn't happen for another 2 years. I tend to think these things will eventually happen, but I couldn't really timestamp them, but just in terms of developing a previous argument, I did timestamp inflation this year, suggesting it would be well over 5%, getting closer to 7% by the end of this year. And if I'm wrong, of course, I'll say, well, that was the theory, and I will be able to explain what happened for me to be wrong, and it would have been the velocity of circulation didn't pick up as much as I expected, or the output grew faster than I expected, or whatever. But it is really me trying to simplify the theoretical relationship between changes in monetary demand, for which the central bank has responsibility, and the ultimate change in inflation. So I do go back and sort of nudge Paul and say, you've caused this, it's your responsibility, you've got to get this under control.
If only the central bank did actually have that degree of control that John thinks it does, everything would be a lot easier. I think what you can expect to see at the moment is my colleagues in Threadneedle Street getting increasingly worried, and the more worried they get, the more you'll see the mood music change. The initial response of policy will be a war of words rather than a war of actions. You'll start to see more hawkish announcements, more talk about when and how quickly interest rates might go up, more talk about how the stock of asset purchases at the Bank of England, which have created the enlarged monetary base, how that might start to be unwound. And you'll only see that coming through if inflation looks like it's going to be stubbornly high. I think they will wait as long as they can. They will expect a lot of the current price shocks to work their way through and inflation to fall back naturally, just as they did the last couple of times we had inflation go up to 5%. This time it looks a little bit more threatening, and I suspect that we will have to see more action than we have in the past on top of those hawkish words.
Thanks very much, Paul, and I'm glad that you're sort of creeping over to my way and thinking that things might be a little bit worse than you originally thought. We're going to stop it there, a little chat on inflation. We don't want to talk too long, and we will come back with further chat on the monetary policy side of things, looking at interest rates and looking at QE. We hope you've enjoyed that, and we'll see you in the next chat. Thank you.
Thank you.